about what are we going to talk about stress testing. First, what I don't wish to waste your time with is stress testing in the regulatory form. You have in your different regulatory areas received and read presumably quite a lot of the documentation from your regulators about what should you do for stress testing. Yes, that's wonderful. And so at this point, your role as a stress tester or any risk manager in the bank is to read the documentation and comply. And the rest is your brain is now out of function. You just have to comply, and so that's it. Finished. Okay, this is regulatory stress testing. What I would like to talk tonight or today, well, this morning or whatever the time is for you today, is about management stress testing. The kind of stress testing that is supposed to, just in case, help a little bit your regulator, your central bank, and so on, to understand better about your bank, yes, but especially about the strategic stress testing that your bank should do, or probably, I hope, does within your bank to inform better about strategic management of extreme risk. We are going to talk about a few excesses of stress testing, especially during the 2007-8 crisis, and what we think in this house should be done beyond, and I repeat, beyond what the regulators ask. I prevent any claims for or accusations of heresy. I am not at all suggesting in any way that you should not comply. I'm trying to tell about what you should do beyond regulation. And so, yes, you comply, of course you do, but don't stop thinking because you have complied or you think you have complied. Regulation is one thing, your management of your bank is one thing. Obeying if what the referee says in a sport match is obviously necessary, no question about this. However, you won't win a match or a race because you have complied with what the referee said. You will comply because you are in whatever way better than the others. Okay, now, what is stress testing now? Especially what it is not. What I hear by stress testing is first, entails a scenario modeling. Why do you need to entail a scenario together? You can do some stress testing in terms of, let's say, one factor stress testing. I've got some model in my bank, some quantitative model, and I stress very strongly one of the factors, let's say, interest rates, and I bump them just a little bit for having some sensitivity testing. And so a big bumping on the interest rates will be called by some model testers stress testing. Yes, you could say that's a stress testing of a model. Here we are talking of stress testing of your bank, which includes generally stress testing of different data. Typical example in 2008, as you probably remember quite painfully, as I do as well, you had a big movement on stock exchange indices, which went down quite dramatically. You had concurrently, and correlated to this, a big movement on credit spreads, which went up and so on. You had at the same time a lot of movements on market liquidity, which obviously, because trust was going down quite dramatically, market liquidity vanished quite, and so you cannot analyze the crisis of 2007-8 with just one element at a time. Bad news came all together. Plus, I forgot as well obviously foreign exchange movements that was quite dramatic, a few threats about your counterparties as well, threatening and sometimes really going bust, and things like this. In other words, stress testing that must include a scenario modeling. Okay, and my biggest horror, stress testing does not have anything to do with capital. Why? Stress testing, by definition, must have dramatic consequences. It's no use to stress a little bit. There is no such thing as a mild stress testing, and so correlatively, it is likely that the likelihood of a stress scenario must be very low. If you try to protect against a stress testing scenario with capital, in the 99-point-something% of cases, when the stress test scenario does not occur, you will waste your capital. And in the very, very small percentage of cases when the stress testing occurs or occurs with variations or something, your capital is very, very unlikely to be anywhere close to anything you have predicted. In other words, capital, even if it could help, well, having money aside, cannot make any harm except waste. Capital won't be enough to repair your reputation, for example. Okay, myth number one I want to debunk here. Capital has got anything to do with stress testing, or stress testing with capital. I say no and no and no. Okay. Second thing is about what is exactly stress testing. We see next slide actually that ambiguities have been quite numerous, coming from the Basel II text and continuing afterwards. Myth number three, stress testing has got to do with regulation. Well, yes, in that word has been hijacked by regulators who thought they could really force every bank in the world to do their stress testing on their behalf and for them. Sorry, no. There is still some exercise of stress testing to be done by every bank. Okay, myth number four, stress testing has got to do with public communication. I will heavily stress that the least you tell about your stress testing, well, outside of your bank, obviously, but the least you say even inside of the bank, the best is the likely quality of your stress testing going to be. And so I believe very much in the need of transparency. Yes, the public has got the right to know, yes, of course, and so on. However, for stress testing, I'm afraid we will have to make an exception in this case. Now, first thing about the definition of stress testing. In the Basel II text, there was some big mention about calibration of models to counter this practice of banks who try to paint the picture in a very rosy color, in the Picasso pink period style. In fact, every calibration of every model, especially credit risk model, was taken with probability of defaults and the loss given default, especially taken from periods of booms. And so there was a point in time option. We take the last one we have. There was boom, the optimistic one, which was not exactly appreciated, and there was as well. Here, not probably, if I can try to put, okay, I put a pen here. Oops, yeah. Here, what regulators on the world wanted is to have a prudent calibration of a mild recession, and that's the word of stress testing were used in there, which was absolutely wrong. Okay, and in this, can we erase this one? Oops, yeah, okay, Great. In this beautiful picture here, what I call stress testing is only the red part of it. The first scenario is a V-shaped scenario, which actually fits quite well with the September 11th scenario, when outlook was not very good already, and then a big chunk, and actually the stock exchange in the world recovered after more or less 10 days. And it was a big surprise for quite a lot of banks, of course, but the recovery of the outlook, let's say, to be short, was relatively quick. The next one here is more a U-shaped type of stress test, which was actually, it's quite mild, this one in terms of impact, but duration is quite long. If you want an example of a very, very long type of stress test scenario, my favorite, if I dare to use this word, is the Japan crisis. In 1989, Japan was going very well. Nikkei was going from record to record and so on. And since then, well, nothing has happened. And 20 years later, and still counting, Japan is still more or less in stagnation. Banks have not made progress, and Japan has quite retreated on the international scene from the promising world power to, well, whatever it is now. And so that's a big and long crisis. Can we still talk about crisis? Not sure, yeah, and it's something for economists, but I think we can definitely talk of stress test scenario in there. And the next one here is, well, another stress test scenario which could happen now, why not, and so on. And so in this, only the red ones are the right one. Anticipated value, we think that in the next quarter, there will be a little drop of GDP and so on. That's not a stress test, that's just a, well, anticipation of the future and so on. Okay, and so dramatic, plausible, and so on. Now, why do regulators need really to put their noses into stress test things? Why? Because they are very worried about contagion risk. In other words, a bank goes, well, not bust, or maybe threatens to go bust, or, well, the fortunes of a bank, perceived or otherwise, go wrong, and so confidence in the financial systems go down, and chains of bankruptcies come up. If you remember well your history books, or your student days, or even better, your banking days, because you have already done this stress test, 1929. Do you remember this? Well, most people don't care, and think it's too old, it's for history books and so on. However, it's quite useful to remember a few things about it. October 1929, stock exchange crash, crisis of confidence and so on, driven by excess of credit in the system, and credit risk management being done like it was done in 1929, which means very badly. And so it took a lot of time in the US to recover, New Deal, Roosevelt, and so on, you remember. And in the early 1930s, the crisis was transmitted to Europe. And the first bankruptcy was Kreditanstalt in Vienna, Austria. And the consequences and the ripple effects and so on culminated in World War II. Pearl Harbor 1941, and a few other episodes which had a lot of dramatic social consequences, obviously. It is quite useful to remember about these ones. We still remember as well 2008, but it's too easy, this one. Okay, problem in there, coming back to regulatory events on stress testing, regulators request banks to choose scenarios. Great, wonderful. And the reflex of most banks was, let's take irrelevant scenarios, or scenarios that we are sure won't really highlight any weakness from our bank, and let's obtain a clean bill of health from our banks. If we had an earthquake in a very remote place in which we don't have any activity, it's dramatic, it's unlikely, it's plausible, it's wonderful scenario, great, and so we lose zero money, wonderful, let's go for the scenario. Okay, but that was a ridiculous thing that led to absolutely nothing. And we are still in resistance in the psychological meaning of the word resistance, in which banks still don't admit that they are mortals like anybody else. Let's try to do an exercise. If you're an analyst or economic analyst or anyway, somebody who does the real and serious work within a bank, and try to report to the board, what if our bank had made a mistake and was under a nasty scenario? I'm sure your success will be seen immediately in terms of, well, if the board is nice and open-minded, you will see some people frowning. If not, we will be kicked out of the room immediately. Problem, because of this waste of time and stupid game playing and so on, the problem is that stress testing before the crisis and after the crisis is still not seen as a priority, because there are so many hurdles to overcome that that even regulators cannot see this as a priority. Priority is generally what they so poetically called resilience of the system. In other words, make sure there is enough capital in the system, make sure that the banks really don't want wreck the world financial system and so on. And let's make sure especially that your regulators, when they go to IMF yearly meeting, they are not really looked by their colleagues like the guys who will wreck the financial systems. Problem in there is that we have got a lot of asymmetric views on stress testing. A scenario that would sink a small bank in one country is unlikely to be taken seriously by regulators. That's one bank failing. Okay, we can justify this. It was a small bank, nobody cared about it. Social consequences were quite minimal. And the system just absorbs the loss, and that was about it. Pity for this small bank, but nobody cares. Okay, done. Okay, however, talk to the management of this small bank as well. And then the view will be quite different. They care about surviving very much. Regulators only care about either too big to fail banks. Yeah, effectively, they have to care about it. By definition, if the bank is too big to fail, the regulators will have some issues with it. But also, especially systemic failure. If any bank has got a systemic repercussion and starts up a new 1929 crisis updated, then regulators will have to care about it. Okay, and regulators, however, should not very much care about a bank having a drop in profit. A bank having to call their shareholder for a few things and so on. They shouldn't so much care, but in fact they do, because of reputation, because of the news being in the press and a few things like this. But theory is regulators should care only if a bank reveals that their management was not good enough, obviously. They should care if a bank fails and excuse me, just water to your good health. Yeah, thank you very much. Great. Okay, and so, but banks should care very much about disruption to management, disruption to processes, disruption to their reputation, and just drops in profit given one episode of one stress test scenario. Yeah, I think. Just in case you still think that regulation was just within a good intellectual historical process in some sort of Hegelian eschatological conception. Yeah. Shall I tell you a few things about when regulation occurred and what was it due to? Basel II occurred in, let's say, 2002, more or less. Why? For some very, very specific reasons. Because there was a few scenarios that occurred before. Actually, 1996, the failure of Barings propped up regulation on market risk and obligation for banks to use value at risk. 1997, about credit risk, that was one. Obviously, 2007 and 8 was the one that propped up Basel III. And we are still now in the aftermath of the 2007 crisis. Greece and failure, or let's say difficulties of Greece and rescue of one sovereign country member of the Eurozone is still propping up European regulation, but also influencing quite a lot. And if we have the crisis, a major crisis in 2019, or maybe later if we have, there will be immediately some new regulation, which will be just a patching of regulation. But I've really given up of trying to think that regulators in their right mind look at very long-term history, look at where mankind and financial mankind is going, and tries to establish regulation which will be have validity for the next century or so. No, regulators are just reacting to the last crisis, patching up for the last crisis, and not for the next one. And so this is why you will see a lot of stress test scenario happening for good, yeah, stress scenarios this time, and new regulation happening for it, trying to answer the wonderful lessons that we just learned from the last 6 months. But very, very few regulators refer to Greek antiquity and antique Greek wisdom to try to establish some new regulation. A few as well proves that illusion is not the monopoly of people who don't have enough knowledge. IMF as well has been very keen to say that the financial system is absolutely wonderful and robust and no problem. Some of this is obviously talking to just a wide public, trying to reassure public whatever it takes. Yes, but sometimes as well the message is so much put to the public that we have too much of lenient speaking. Telling, okay, big lesson for this. If any regulator or bank manager say, my bank is resilient, my system is resilient, my bank is safe or whatever in this one, please analyze a few much more deeply about the bank and this one, and don't invest in this bank. Now, what was wrong in 2008 with the big failure of stress test scenarios? Most banks actually didn't want to have an exercise of a stress test which will affect the whole bank. They prefer to have stress tests on just one scenario, stress tests on one location, and stress tests that did not really disturb the board of the bank, of the consolidated banking group, and so on. And so very, very much isolated thing. And the top management of the bank generally did not take this seriously. The instructions for the stress manager were mostly find a scenario that proves that we are very good, yeah, and make sure that we don't really lose any money. Actually, from personal experience, I had once to work on stress test scenarios for a bank that was overcapitalized by all standards. The Cook ratio, by my very quick calculation, was around the 18% mark, which is obscenely high. Just in case you don't recall, minimum was at this time 8%, and 10% was considered just the median of any bank. And so 18% was really a bank wasting its money and so on. And the bank absolutely wanted some scenarios saying, well, a drop of 10% of stock exchange, yes, okay, we have got very little equity investment, and so that's a very good stress test because we lose practically zero, and our Cook ratio comes from 18 to 17.9%. Okay, that's a very good test. I say, no, so, not so, sir. Yeah, excuse me, but a stress scenario must be stressful for the bank. Ah, yes, but what scenario will be stressful? Well, stock exchange going down 99%, it would be unrealistic. No, sir, scenarios will be your shareholders wanting you to waste less of your capital and be more active and, well, a revolution of the board. Faces went crimson red. It cannot happen. Fred, stop it. Fred, stick to economic scenarios. Don't touch it. Ah, okay. I saw here I had touched really where it hurts and where the stress test scenarios should have been there. And obviously, the bank was absolutely adamant that I should not put my nose any close to this. Yeah. Morality, resistance will be met as soon as the stress test scenario is a good one. Now, the principle of stress testing, and some of them being actually accepted by regulators, it must be high impact, must be drastic. Unlikely, yes, but plausible. And so we don't care very much if the probability of the scenario happening is, let's say, 1% or 0.01% or 0.001. It must not be zero. It must be somewhere very small. But actually, we don't very much care if it's 1 out of 1 million, or 1 out of 10 million, or whatever, because we don't know very much. We don't have enough relevant history for this. Okay, it must be relevant and painful. Painful, obviously, yeah, but relevant. Big thing, it must be relevant to the precise bank. It must, in fact, the scenario must really jeopardize the strength, the strategic strength of the bank. In other words, for each bank worth its pinch of salt, there must be a few specific scenarios that will hurt only the bank. In other words, hitting only the reputation of this bank and not the competitor, or the bank having some internal mishap, where rogue trading will be quite a good one as well, and the bank being more affected by some sort of macroeconomic crisis, and the others will be some other good scenarios. But a general macroeconomic crisis will have only a certain degree of relevance with the bank. Natural catastrophes as well within the locale or the geography of the bank will generally be good, but for global banks, obviously, it's more difficult. It must be intellectually, conceptually sound. In other words, there should be quite a lot of research being done in terms of causes and consequences of the disaster and the logical linkage between the catastrophe happening. Catastrophe, it means in the Greek sense, in other words, breakdown of time series, discontinuity of time series. In other words, sudden drop, which makes a graph of anything relevant looking like discontinued. Okay, a catastrophe bringing a disaster, in other words, a loss. And so there must be somewhere in the stress testing team some good understanding of what would cause a good loss. And it must be as well provable. The problem of probability generally goes against the problem of unlikely. If you try to do some stress testing which is too robust, you are going to have to refer to stress test scenarios which have already occurred. And so you are limited to the scenarios which have already occurred. And yes, you gain very much in terms of soundness, because you just say, oh, in 2008 this occurred this way and so on. However, the next crisis is very unlikely to have a lot of common with 2008. Why? Because in 2008, the banking community has spent a lot of gray matter and capital and energy generally to try to prevent 2008 bis happening again. And so what is likely to happen in the next, the 2019 crisis, for lack of a better christening of this crisis, will be something different. Not probably the subprime in the US, because there has been hopefully quite a lot of reforms being done, not the sort of lack of implementation of the Basel II Accord, because it has been implemented and so on, but different causes. The stress test exercise must as well include several scenarios. It's useless to have only one scenario, because the future is rich enough in possibilities to have a lot of different things. Personally, but it's just a matter of specific taste. I like very much to have a brainstorming in which up to, let's say, 50 possible scenarios are mentioned. Yeah. Just mention again, so as to end up with a handful of scenarios being deeply studied. The key for the 50 minus 5 equals 45 scenarios that will be discarded is to make sure they are discarded for good reasons. Because they are too unlikely, because they are attached to some other things, because if the scenario happens, they will happen progressively, and so, or whatever other reason, but make sure the scenarios that are discarded for good reasons. A scenario being discarded because the board does not like it is generally the greatest scenario you can ever devise. If there is resistance, that's because the scenario is a nasty scenario. Okay, other thing as well, it must be used as an integral part of risk management, says the regulator, and says common sense as well, because stress testing requires a lot of work, and so on. And it must especially be used to inform as well the process where the vulnerabilities are, the strategic vulnerabilities, and what is the risk appetite of a bank. On risk appetite, I'm going to speak a little bit later about it, but there is some progress to be done on this one as well. And it should include as well some idea of a reverse stress test. What is reverse stress test? That's basically, instead of saying, let's imagine a scenario and let's see how should it hurt, would it hurt my bank if it occurred? Let's try to see the logical chain of events differently. First question, could my bank die? If no, start again, because every bank has been, is likely to die at some point. Okay. Now, once you have answered, yes, my bank could die, why, and what sort of event could propel the bank into bankruptcy. And then you work the chain of events from the final result into the different causes. And so the great thing with this approach in reverse is that you end up with your bank on paper, obviously, or on hypothetical scenario being bankrupt. And the great benefit, we are going to speak later about this, is to have preemptive protection measures. Preemptive, it just means before everything can even happen. And protection measures, it does not mean capital. It means probably monitoring of a few things. It means it can mean diversifying. It can mean limiting investment on something. It can mean a lot of different things. But it does not mean just capital. I have a model in which after an inventory of different risks and their characteristics, I set a set of possible policies to just handle this risk. And believe me, within the 20 or so main possible policies, capital set aside is just one of them, and generally the most costly and the least efficient to use. The 19 others generally are more brain intensive, obviously, but much more efficient. In terms of now the practicalities of getting into the stress testing exercise. Well, first thing is understand about your bank, please. A stress testing cannot be done in just a blank and for every bank the same, and you fill the form like this. It cannot be done like this. Your stress testing must be done in that it addresses for your bank what big strength in the business model, in the type of asset, in the competencies or whatever else is there in your bank. How does your bank make the wonderful profit it does? Because of the genius it can have? Yes, of course. Okay, then what sort of scenario could deter the wonderful genius to continue to work for your bank? What could attract the key brain power to go for another bank, and so on? And then find a scenario that will jeopardize the strength of your bank. And then get into an exercise now of selecting scenarios, redesign scenarios, probably find variations to them, calibrate the scenarios, and understand better about the causality and so on. And please don't fall into the trap of saying, oh, this scenario is too nasty, let's make it milder and milder. There is no such thing as mild spicy food. Yeah, mild spicy food is just a contradiction in terms that well, either you have spicy food because you like spicy food, but as soon as your customer in your restaurant try to say, don't make it too much, you are wasting your time, and the result is unlikely to make any sense. Now, final test. After you find the data, and I pass very quickly on the exercise of data feeding into this stress testing model, because it's generally a very difficult exercise. Data will be quite complex, generally of low quality, low availability, and so on. Yeah? And so the culmination of this exercise is find what will be the final outcome of this stress test scenario. Is it a big loss or not? If not, you have wasted your time. Start again, please. Yeah. And once you have decided within the stress test team that this scenario will hurt your bank big time, then report them. And please never, ever, ever get tempted to say, because of top management recommending don't stress me too much, to decrease the magnitude of the stress test. Then it's, well, still mild spicy food. Yeah. In other words, that's nothing. Okay, and so reporting, but try not to change any stress test. And so after this, get any sort of decision maker to influence very much as they like in what sort of risk management plans can be put in motion. And it's a stress test with a hyphen. In other words, that's not test of a stress or testing the stress tester or something. It's the word is stress testing. Yeah, and so the stress must be on the subject, the object to be stress tested. In other words, the bank itself, the bank processes, the bank's ability to make profit, and so on. And so the risk management plans must be alongside the plans to make profits on a consistent basis. The risk management plans must be set aside, set up and set in motion so that the bank can continue to make as much business as appropriate, but be flexible and robust and resilient to any sort of further stress test scenarios. And so the stress scenarios that are selected must be consistent and challenging, so that any sort of nasty surprises must be reacted to very, very quickly. In terms of especially credit risk-based stress testing, when one specific type of credit risk I like very much to stress test is what if we have lent to such markets for years and years based upon a model, and we get now aware that the model that we have has been calibrated in some way, and the recalibration went a little bit floppy over time. Obviously, the creator of the model has gone away long ago, and so we now suddenly get aware that in fact the recalibration is found wanting a little bit, and we are now lending to doing long-term lending to a lot of customers on the basis of a PD model, of a probability of default model, which is no longer satisfactory. Now, what do? We have now a portfolio of lendings which are in fact priced a little bit wrong. We need first, obviously, to, in emergency, review the model very deeply, especially where we have not seen why. We need to reassure everybody relevant that the model is still viable, especially when it is not. And we need to recorrect our portfolio progressively and make sure we do whatever. This can move a lot of brains everywhere in the bank here. Yeah. Okay. And so, because I mentioned about the trauma that any stress test, even before the real scenario happen, can inspire. And believe me, we don't talk to rational people when we talk of stress tests. Talk to your manager about your brilliant manager. Sorry, yeah? Of course, he's brilliant. Yeah. Talk upstairs about another way to make profit. And you will see a very good conversation taking place about, yes, we can improve our way to make profit, we can go for other markets and so on. And you will see adults talking. And that will be a beautiful conversation about how we can use every opportunity that life can provide to our bank. Wonderful. Now, do the same exercise with the same people, talk to them about stress tests, and then you will talk to 5-year kids now. Okay, and then the typical thing first, it cannot happen. It cannot happen. Yeah, okay, great. Why cannot it happen? Because my imagination is limited. Okay, chef, yeah, that's good. Okay, now it never happened before. Okay. Is it a reason why tomorrow cannot happen? No? Okay. Yeah. Or maybe it never happened before because the history books have not read them or have forgot about them. It happened before, but we want to forget it. Okay. Our bank is built not to withstand disasters. Well, that's true to a limited extent. If the Earth explodes, obviously your bank is dead and nothing can be done about it. Yeah, and we can, if you insist, get into some ad hominem type of defense. Well, you, the stress tester, you, Fred, yeah, or you, the risk manager, you are a pessimist. And if the risk occurs or happens, or even if we can think about a stress test scenario, that's because of you. You are a pessimist. What do you know about this? Yeah, you know nothing about this, and so we attack your competence as well. In the type of more stupid ones, we have insurance against that, and so we don't care about paying whatever insurance premium. Yeah, and so yeah, the risk is big, but we just throw away just insurance premium at the risk, and we don't need to do anything. Okay, I will believe this maybe another time. But if we have an insurance about risk, we don't need anything. Yeah, great. And then the last stupidity. Oh, we cannot put aside capital for this. Who said that because there is a stress test, we talk of capital? No, thank you. Yeah, I've said it before and I said it again. Yeah, and so I'm not sure which one is the most stupid of these ones, but all of this has been heard in practice actually by bank managers who just want to find any sort of reason to refuse stress tests. And obviously, some stress tests generally. Invasion of aliens, I like to discard this kind of stress test, obviously, yeah, but a lot of them as well should not be discarded. Actually, in terms of personal experience as well, I was in Kobe, Japan in 1995. Yeah, and just 1 month before an earthquake that cost 5,000 lives, more or less, I heard from some local powers that be, in Japan, earthquakes are for Tokyo place. In Kansai, which is a region of Kobe, there is no earthquake typically. Yeah, but typically stopped when I saw it, yeah, and that was quite obviously psychologically painful to see. Obviously, this universal truths going wrong, but also so many people paying with their life for this. And so this cannot happen. Please don't tell this to me. Yeah? Well, find some more clever answers, please, before you refuse stress test. Yeah, next one about now, assuming now within the stress test project, we have the team have been able to set up a few stress tests, try to understand and dig a little bit deeper about what could happen, what could not happen, how the bank could suffer and why not, and so on. Right, yeah. Now, universal principle of management of, let's say, modern management, some people would tell it, is transparency. If you do some good things, if you manage your bank well, nobody should really take it bad if they learn that your bank is doing well. And so do it well and make it known. Yeah, that's a general principle. However, the public and any analyst as well, generally, when they see the stress test scenario, the next thing they will say the next second is, oh, the scenario will happen. And so I cannot invest or I cannot recommend this bank or I cannot do anything because if the scenario happens, they will lose this much money and so on. And so generally the investor's caveat is overmanaged in terms of communication. obviously the risks are selected as the risks being well, unquantifiable, the risk being really very much generally not very much event-based. Yeah, so that every investor can say, well, I can invest and monitor this risk, but that's all what I can do, monitor the risk and so on. Yeah? And so in the case of stress test, well, especially I'm worried about if any kind of activist sees in public information some news about stress test. Whatever an activist with a few nasty ideas will extrapolate from this, I don't dare to imagine about it, and so on. And so the list, the stress tests are communicated, the better it is. If there is something to communicate about stress tests, it's mostly the measures that have been taken because of the stress test to protect against risk. Example, because of any scenario that you don't need to know has been examined, we think of limited our exposure to this geographic area. And so we set the limits in terms of trading, general physical exposure or financial exposure or whatever else and so on. And we hedge the credit risk on this one, we hedge this, we hedge that, or we rediversify, or we do some natural or strategic hedging and so on. And maybe the final measures can be communicated, but that's about it. And regulators obviously would like to see about managerial stress test. Here I cannot tell you how to manage this type of communication and policy of this, trying to put the regulator in confidence. But obviously managerial stress tests are the type of information that should be very much put aside or put, well, not privileged in terms of okay. And so generally as well, the public will mix envisioning a scenario, thinking of a scenario being plausible, but not trying to set up some kind of speculative kind of probability on it. Yeah, and so a scenario is possible, plausible. Yeah? It does not mean that I predict the scenario. If I predict the scenario, I try to have some sort of likelihood put to it. Here, when I talk of scenario, I talk of stress test scenarios, which are very low probability, but non-zero probability. Yeah. And so envisioning is one thing, predicting is a totally different one. The stress test, if it's well done and if it's used for something, it's supposed to reveal strategic vulnerabilities. The last thing your competitors need to know. Yeah. This is another reason why, obviously, stress tests should be kept under closed doors. Now, we mentioned as well that stress tests must be used not only and practically not to reassure the public, not to reassure any regulator, but especially to be some sort of extra information to be integrated within the risk management wisdom of the bank or financial institution. Sorry, an aside as well, just in case we have non-banking financial institutions people here. When I say bank, I mean financial institutions that are non-banking as well. And so don't be upset if I talk of banks and it's any sort of financial institution. Okay, now risk management should, regulatory theory say, inform about risk appetite. Whenever I make some sort of an opinion poll to my participants to seminars about what is the risk appetite of your bank, I get generally a very, very nice consensus across all the banks. My bank is very prudent. That's wonderful. I'm very reassured. Okay. Next question, sir. Is your bank very risk knowledgeable? Oh, yes, we are. Of course, we are. Yes. Yeah. Okay. Now, you told me you know very well about the risk and you don't take the risk. Yeah. Even the risk, and especially the risk that will be remunerated in terms of extra profit. And you told me as well at school that business of banking is business of risk management. Now, next question. Now, nasty question. What the heck does your bank do with hiring so clever people like you and not taking any risk and presumably having a return on equity, which is just, treasury bills and so on, and plus a little bit of luck probably. Yeah? And so why does your bank, when knowing the risk, does not take the risk? Yeah, I don't know. Yeah, great. In other words, there is quite a big discrepancy between risk appetite being perceived and communicated as well, and actual risk appetite of a bank. And I even speculate that the risk appetite for ordinary risk, which is high likelihood but low impact, and stress test, tail risk, which is very low probability and high impact, this kind of risk appetites are just disconnected. Yeah, and so you could be a very, very prudent bank in terms of daily risk. The bank of the village, practically in retail, asking quite a lot of securities for any lending, and in fact being very risk-taking in terms of natural disasters, breaking of local dams in like it happened recently somewhere, and so on. And so all your physical places will be very much within the area close to the dams, which means you have got a very big physical risk, which you don't want to ignore, and so on. And so you are very much risk-taking in terms of stress testing risk. But for all the other risks, you are very prudent and very shy bank even, yeah, I will say. And so some risk appetites can be very disconnected, and also the risk, the awareness about your own risk appetite can be as well, is generally extremely low when you talk of tail risk. So when the stress testing team has been able to identify a few stress test scenario and got better integrated within the process and got more knowledge into the bank, the next step is more difficult now, to have senior management themselves identify stress scenarios. Generally, when asking about stress scenarios to people who are very much into line management, the typical answer you get into, "Oop, nothing can happen to me. Yeah, it's impossible," and so on. However, my colleagues, especially my peers, who compete for me for the next promotion, yes, I can identify very much a lot of very big scenarios. Scenarios that, starting by my colleagues, makes a mistake. Yeah, and so you get very much drawn into a political game, which generally, obviously, is quite not exactly palatable to most people, but also very, very unproductive. And so the key as well is to be able to have a set of stress tests that can be communicated with a few reservations, obviously, as I mentioned before, to senior management, and being used in diversifying, use in maybe not getting into dangerous activities, into hedging, into transforming every tail risk that we can identify this way. But the key is to be able to use the result of the stress testing the exercise for strategic risk management. Generally, as we mentioned, risk aversion and awareness as well, and talking about strategic information about our stress testing. We have Boston Consulting Group type of matrix in which we have the risk-taking and the risk-adverse type of guys, the risk-aware and the risk-ignorant players. And typically, most people see themselves in the category of wasters, in that they are very prudent, very very careful, but very knowledgeable about things. Generally, I like very much the shy players who just know they just don't want to spend money or brain power or anything else of trying to understand the risk. Yeah, and they don't take the risk. A local bank concentrating on retail and not taking much risk in terms of investment banking, I'm fine with it. That's a perfectly legitimate kind of business that deserves a lot of respect. And so if your bank wants to be just bank of the village, make the profit due to your expertise of the knowledge of the village inhabitants and make money out of it, that's perfect for me. Where I get a little bit more worried is when your bank tries really to get very much aggressively into investment banking, and Bank of the Village see itself as a miniature superstar of the world. Then it becomes very much a kamikaze type of bank, and the next thing you know is the bank will have big losses in terms of being exploited by your counterparties, giving you some nasty toxic derivatives, or just misinvesting, misunderstanding anything, or having rogue trading and so on. That's a typical destiny of this bank, which doesn't see itself like the bank it is. And the stars, the typical example of a superstar is once upon a time there was a bank called Lehman Brothers, which was very, very active in very bleeding edge of derivatives, energy trading as well, and a lot of things, and especially recycling subprime. Well, if you remember 2008, well, you will probably have learned that being a superstar that can last sometimes, and it's not a given that a superstar of today will be the superstar of tomorrow. You have really to review constantly your risk policies, make sure you are really at the top all the time and not sometimes. And there is quite a lot of potential for a star to fall down to kamikaze, at any minute, and then obviously the consequences can be dramatic. Lehman Brothers, obviously, history just showed what happened. It went bankrupt and it was not rescued. It was cut into pieces, and some pieces were rescued, but under a different shareholder, different guys, different name, different everything, and so on. And so along the diagonal of this diagram, every possibility is okay. But if you go up the diagonal, you become a waster. If you go down from the diagonal, you become a kamikaze. And especially in stress testing, I've seen quite a lot of the attitudes towards this. When let's say if a bank gets created, it starts really at, if I can show it, can you see it? It starts here, and so the bank learns a little bit, and so shy player, because I am aware I don't know enough about the risk and so on. And so every sort of attitude can be met as well, and the pitfalls on the way are quite numerous. Especially, I like very much to see the typical young trader who makes a good first trade. He got very much threatened to, wow, now I've cracked it here. Now I've understood how to trade, and so, yeah, I am the genius now, and so on. Okay, this guy is dead the next trade promised. Yeah. Okay, and the only way we can survive quite long, it has been working so far. Make sure you know the grammatical tense of it. It has been working so far. Yeah. It does not mean it works. Yeah. Okay. Let us try to understand better and more to continue on this trend and so on. Yeah. Okay. And so it works. Let's continue here. We have got a problem. Yeah. That it works. Let's requalify this one. And so when you see trading risk, you can observe these behaviors quite clearly and quite quickly when some egos or psyches can go from really, I don't know, I'm learning, yeah, to any of these positions afterwards. When you talk about the board or the top management of a bank, and you see the same problem here, the consequences are much, much more dramatic than this. History is quite rich in boards who can tell you, well, we are a very traditional bank, you know, we have been doing a lot of things in the past, that's absolutely wonderful. We have accumulated whatever and so on. Yeah. Actually, a bank in Italy just likes very much to advertise or communicate. Oh, we are one of the oldest banks in the world. We have experience, from centuries of experience and so on. So what? Are you still expert in the top banks in the world now? Answer, no. Yeah, and now you need to be rescued. Yeah, or another bank called Barings, who was very keen to say, oh, we have sold, we have participated or arranged the sale of Louisiana, roughly middle west of the US, as it was at this point in history, from Napoleon to America, and it was an extremely big project, which was a very successful sale. Yes, great, wonderful. What year was it? Can you recall me? Ah, okay, yeah, it was history now. In 1996, how much expert are you in futures trading in Singapore, Mr. Board Member? Well, we have some guys who know very well. He's a genius. He's called Nick Leeson. Great, yeah, okay. Next page in the newspaper is Barings failed and so on. And I leave you to examine what sort of attitude was just prevalent at the board at this point. And so don't believe because these guys are clever, yes, they are clever. Because they are experienced, yes. Because they know banking well, yes, they do generally. Yeah. They just cease to be human. They are still really, people with cognitive biases, with psychology, which can be pathological as well sometimes and so on. And they can as well be perfectly sane people, but under some stress situation like financial crisis, turn to anything. Yeah, they are humans as well. Yeah, yeah. And so stress testing needs to be done at a strategic level, and you should never, ever, ever ignore psychology. Yeah. Especially when you get into some answers like this stress scenario cannot happen. Yeah. You are getting to talking to some kids who just is just occupying the body of an adult, yeah, who has been traumatized by whatever, and who doesn't want to see the trauma. And so go as deep as possible in analyzing the stress test scenario if you see some resistance like this. Okay. I want to add as well a few different classical mistakes as well, or cognitive bias as it can be called and so on, which can be quite dramatic in terms of ignoring stress testing. I just, take, especially focusing on daily measures, the second one in the list here, where typically the short-termism of bank management can strike very much and say, well, the crisis you mentioned, or this stress test scenario, will happen if it does within a few years, and by then we will have done a lot of profit and so on, and rely on historical data as well, like this. Well, Fred, there has been no such crisis in the last 20 years, and so why should there be a crisis now? Okay, because the past is no guide to the future, sir. And well, you cannot judge because there has been no crisis. There will be no crisis. Tensions may have accumulated somewhere, and well, anyway, you don't know the future. And please be a little bit more imaginative for the future. The future is not a time series that you can extrapolate. It's much richer than this, and the future is much richer than your poor imagination, sir. With all due respect, obviously. Right. Okay. Now, once these stress test scenarios have been established and so on, the job is not finished now. You will probably see, and the stress testing exercise will probably teach you the very hard way. The next thing to do is a huge task of the data you have in the bank, which will help you to explain what is the vulnerability of the bank to such and such scenario. This data needs to be cleaned, needs to be better used, and so on. Nightmare number 2 of a stress tester is, well, after number 1 is nobody believes me. Number 2 is I cannot access the data. I cannot get the data to speak. I cannot get the data in good quality enough, or well, the data is absolutely crap, inconsistent. Now, the second one is improve the bank-wide, and I stress bank-wide, risk measurement system. Risk measurements are typically built to measure risks that can be measured. Oh, what you can measure is what you can manage. Yes, of course, but what you cannot measure, should you ignore it? Well, you cannot measure the risk of meteorites, What is going to happen if meteorites fall on your head? You just say, well, I couldn't measure it, and so, no, okay, let's more seriously, let's try to measure as much as possible, but sometimes the risk cannot be measured. Let's really, even as much as I love measurement and mathematics and quantification, sometimes it's not possible. Expert judgments must be used in this case. And obviously, expert measurement is biased, is subjective, is whatever. Okay, it's very bad. But we have nothing better. And then assess the risk factors, the influence of tensions in the financial system as well, influence of debt as well. When is debt too much? When is debt going to produce a credit crisis and so on? And so do not let management feedback revise the assumptions. 9 times out of 10, the assumption will be revised down and diluted so that there will be nothing nothing dramatic in this one. And so the other tasks here, that's a serious one, that's a more difficult task in there to do. Now, what to do with the result? I didn't yet mention as well revise contingency planning. Especially I'm thinking especially about political risk. One of the key ways that foreign political risk especially can be managed. You can prevent it using the CIA and a few other shadowy some institutions. Yes, of course, you can, but whenever there is a mishap in a country, the contingency planning is quite a relatively cheap way to avoid that a revolution transform into dramatic losses for your bank and so on. Be ready to evacuate quickly, physically and financially a country is quite a good one as well. and generally generate action or potential for action, generate plans for action is one of the good fall downs or fall consequences of having good stress tests and so on. Okay, the lessons we have been able to see within the major losses. In public loss database, or actually well, public in terms of non-confidential loss databases, a few institutions, software houses and a few others have public loss databases which must be used definitely by every bank to try to see within the last events of dramatic losses what can be used. Within this event, even if nothing happened to your bank or if you don't want to remember, the past events with a few tweaks can be done to fit your institution. Yeah? And so you can rewrite the past into a potential future for your bank in terms of stress testing. This can be done systematically and quite a lot. And I think I've talked enough about the benefit of stress testing, but they are quite numerous, and the benefits are most for having a better strategic management. Yeah. Please do not consider the benefit in terms of reassuring the regulator or reassuring the public. It's quite a very, very low side effect of having good stress tests, this one. The best benefit of a good stress testing is having well-informed risk management in general, and so on. And I want to conclude before the next 10 minutes of questions. Please be as little influenced as possible by the period of 2008 and 2009, which was a post-crisis trauma. Try to read history book as much as possible, and especially the history of big changes in the financial world, and use your imagination when history is incomplete. So. And especially use the stress test as a strategic tool for management. Some final wisdom as well, yeah. If you just say, as people working for big banks will generally do, yeah, my bank is big enough, we can have big damage everywhere, nothing can fail us because we are geographically diversified. Yeah. Actually, that's a short sentence by Alan Greenspan, the specialist of long and complicated sentences. For once, he could say something. And so I read, better risk management may be the only truly necessary element of success in banking. Better risk management, yeah, and it includes better tail risk management. Yeah. We still have 10 minutes, which were planned for question and answer sessions. I then welcome your question. Maybe can Jennifer tell us if we have questions